spikes and stacks. This is what we have to be concerned about.
The warning didn't come from a protester in the street or a partisan senator on cable news. It came from a man who has spent his life studying the slow-motion collapse of empires. A man who reads history not as nostalgia, but as a balance sheet. And what he said, quietly, without drama, should have sent a shock through every institution in Washington. Because when Dalio says the monetary order is breaking, he is not making a metaphor. He is describing a system cracking under pressure, and he is pointing directly at the political behavior that is accelerating the fracture. This is not about market volatility. This is not about a bad trading day or jittery investors. This is about trust, and the moment when trust becomes optional. The global financial system runs on one fragile assumption, that the United States, regardless of who occupies the Oval Office, remains predictable, bound by law, and fundamentally rational. That assumption is now being stress-tested in real time, and the stressor has a name. Here is what actually happened. Standing at the World Economic Forum in Davos, surrounded by central bankers, sovereign wealth managers, and heads of state, Dalio did not talk about interest rates or quarterly earnings. He talked about wars, not the kind fought with tanks and missiles, but the kind fought with spreadsheets, reserves, and silent decisions made in capital cities, thousands of miles from Washington. Capital wars. The moment when countries stop arguing about tariffs and start asking a far more dangerous question. Why are we still financing this? Because that is the unspoken deal at the heart of American power. The United States runs massive deficits, issues oceans of debt, and consumes more than it produces, not because it is fiscally disciplined, but because the rest of the world has agreed, implicitly, to keep buying, to keep holding dollars, to keep treating U.S. treasuries as the closest thing to risk-free in a risky world. That agreement is not written into any treaty. It is not enforced by law. It exists entirely on confidence. And confidence, once shaken, does not return on command. Dalio's warning was precise. When political leaders turn trade into a weapon, when they threaten allies as casually as adversaries, when they float territorial fantasies and tariff ultimatums in the same breath, the damage does not stay contained. Trade wars metastasize. They bleed into capital flows. They infect currencies. And eventually, they reach the core question every creditor asks: do I still trust the borrower? You could hear it between the lines. Countries holding massive reserves of U.S. dollars and treasuries are watching Washington issue more debt while simultaneously signaling chaos. On one side, a government that needs constant financing. On the other, creditors who are beginning to doubt the wisdom of continuing to provide it. That tension is not theoretical. It is structural. And once it becomes emotional, once it becomes political, it becomes volatile. This is where the story stops being about markets and starts being about governance, because the behavior driving this erosion is not accidental. It follows a pattern. Authoritarian-leaning leaders do not respect systems. They test them. They do not value stability. They exploit uncertainty. They treat institutions as obstacles, norms as weaknesses, and alliances as leverage points. The goal is dominance, not equilibrium. And in that worldview, collateral damage is not a bug. It is a feature. We have seen this movie before. In the interwar period, as global trade fractured and nationalist economics took hold, capital retreated behind borders. Currencies became weapons. Debt became suspect. Countries stopped trusting one another's promises, and the result was not resilience. It was collapse. The lesson of that era was supposed to be permanent. Economic interdependence is stabilizing only when it is paired with political restraint. Remove the restraint and interdependence becomes a liability. What makes this moment so dangerous is not just the rhetoric, but the normalization of it. Threatening tariffs against allies, floating the idea of acquiring territory through economic coercion, treating international agreements as temporary inconveniences. Each individual act can be dismissed as bluster. Together, they form a signal. And markets, unlike political bases, do not cheer for bluster. They price risk. When investors fled U.S. assets and treasury prices tumbled, it was not a mystery. It was a message. Capital is sensitive. It does not wait for constitutional crises to be formally declared. It reacts to tone, to trajectory, to the sense that the rules of the game are changing mid-play. And when that capital looks for safety, it does not ask who won the last election. It asks who can be trusted to honor obligations when the pressure mounts. Dalio pointed to gold not as a trade, but as a symptom. Gold does not pay interest. It does not generate cash flow. It simply sits there, inert, indifferent to politics. when gold surges to record highs, it is not because investors suddenly became sentimental. It is because they are hedging against something more frightening than inflation. They are hedging against disorder, against the possibility that the institutions they relied on to arbitrate disputes and enforce contracts are being hollowed out from within. This is where the legal and constitutional dimension becomes unavoidable. The credibility of U.S. debt is inseparable from the credibility of U.S. law. Treasuries are safe because courts enforce contracts, because power transitions peacefully, because policy changes occur within defined boundaries. Undermine those boundaries, and you undermine the asset itself. When a president treats the law as negotiable, when due process is framed as an inconvenience, when loyalty is valued over legality, the signal to the world is clear. The guardrails are loosening. This is not an abstract concern. It is measurable. Foreign central banks do not issue press releases announcing their doubts. They adjust allocations quietly. They diversify reserves. They shorten maturities. They explore alternatives. None of these moves cause an immediate collapse. That is the illusion that makes this so dangerous. The system does not explode. It erodes. Slowly at first, then all at once. And once the erosion reaches a tipping point, the consequences are brutal. Higher borrowing costs, a weaker dollar, reduced fiscal flexibility, a government forced to choose between austerity and inflation, social programs squeezed, defense budgets strained, political extremism fed by economic pain. This is how financial instability becomes social instability, and social instability becomes a democratic crisis. The cruel irony is that this trajectory is entirely self-inflicted. No foreign adversary needs to sabotage the United States if its own leadership is willing to do the work for them. You do not need to defeat an empire militarily if you can convince its creditors that it no longer takes itself seriously. That is the essence of a capital war. It is fought without headlines, without explosions, without flags. And by the time the public feels it, the options are already gone. History is unforgiving on this point. Reserve currency status is not a birthright. It is a privilege maintained through discipline, predictability, and trust. The British pound did not lose its dominance because of a single bad decision. It lost it because a series of political and economic choices convinced the world that Britain could no longer underwrite the system it once led. The United States is not immune to the same logic. Power follows credibility. When credibility decays, power migrates. What makes Dalio's warning so chilling is not that it predicts an immediate collapse, but that it identifies a phase change, a movement from trade disputes to capital suspicion, from rhetorical conflict to financial consequence, from noise to structure. Once that shift occurs, reversing it requires more than speeches. It requires years of consistent behavior, years of restraint, years of rebuilding trust that was casually burned for short-term political gain. And this is where the psychological dimension matters. Leaders who thrive on confrontation rarely recognize the difference between leverage and fragility. They interpret pushback as weakness and escalation as strength. In domestic politics, that can be rewarded. In global finance, it is punished. Markets do not admire bravado. They fear unpredictability. They flee from leaders who confuse dominance with stability. The tragedy is that the warning signs are all there, and they are being ignored because they are inconvenient. Because acknowledging them would require admitting that the damage is not coming from some external enemy, but from within. From a political movement that treats complexity as betrayal and expertise as elitism. From a worldview that sees institutions not as safeguards, but as obstacles to personal power. This is not about ideology. It is about competence, about whether the people steering the largest economy on Earth understand the system they are playing chicken with. Dalio understands it. Central bankers understand it. Sovereign investors understand it. The only question is whether the political class will listen before the consequences become unavoidable. Because once capital decides it has had enough, there is no emergency meeting that fixes it, no tweet that reassures it, no executive order that commands it to return. Capital moves on incentives and confidence, not loyalty. And when it leaves quietly, efficiently, and without remorse. We are standing at a hinge point. Not a crisis yet, but a pre-crisis. The moment when warnings are still possible, when course correction is still theoretically available. But hinges swing both ways. Ignore the pressure, and the door closes behind you. Hard. If this feels abstract, it is because abstraction is how systemic risk hides, until it doesn't, until borrowing costs spike, until the dollar weakens sharply, until the safety net starts to fray. And then the same voices that dismiss these warnings will ask how it happened so fast. It didn't happen fast. It happened because warning after warning was treated as noise, because expertise was mocked, because institutions were politicized, because trust was spent like an infinite resource. Ray Dalio did not sound alarmist. He sounded tired, like someone who has seen this pattern before and knows how it ends. This is not about predicting doom. It is about recognizing trajectory. And the trajectory, right now, points toward a world where American financial dominance is no longer assumed, but questioned, where the cost of political recklessness is paid not in headlines, but in balance sheets, where the erosion of democratic norms shows up not just in courtrooms, but in currency markets. If you want to understand the real stakes of this political moment, stop looking only at rallies and polls. Look at where the money is moving. Look at what the most sophisticated actors in the world are quietly preparing for. They are not preparing for stability. They are hedging against chaos. And here is the uncomfortable truth. The algorithm will not surface this for you unless you force it to. Outrage travels faster than analysis. Soundbites drown out warnings. If this matters to you, if you want to stay ahead of the damage instead of reacting to it after the fact, you have to actively push this kind of information into your feed, engage with it, share it, keep it alive. Because silence and complacency are exactly what allow systemic threats like this to grow unchecked.